What's up, everybody? Thank you so much for joining us for another lender Q&A call. If you're part of our community, you're going to be receiving this Q&A call as a recording, so you can go back and rewatch it. You're also going to get the Excel worksheet, which I'm going to show to you guys today in that email with our whole lender list. So if you want to join the community, feel free. Now let's get into it. Joseph Morley, how's it going, brother?
It's going great. Pleasure to be on here. Letting you guys know exactly what we do and excited for the chat ahead.
Awesome. So yeah, today, guys, we have Joe Morley with us. He's with Park Place Financial. Really excited to have Joe on because Joe was one of those lenders that was clutch for me a couple weeks ago, and he seems to be clutch on a lot of deals. So, Joe, I'm gonna let you just kind of give us a elevator pitch, kind of what you guys do, just generally, and then we're gonna dive into the Excel sheet. We're gonna, look at your parameters and dive a little bit further into it. So tell us a little bit about Park Place, maybe how you guys got your start. You can even tell us how
Yeah,
you got your start in commercial lending, man, because a lot of the guys that are coming to me, they're either resi brokers or maybe they're just entrepreneurs who want to start running a commercial mortgage brokerage. So if you want to talk a little bit about that, that's great as well.
yeah, absolutely. Appreciate it, John. So my name's Joe. Work with Park Place Finance. We're a direct lender out of Austin, Texas, but we do service nationwide. So, you know, depending on which state you guys are in, most likely we're going to lend in that state there. So we've been in the mortgage industry since 2006. That's when the CEO first got his start in the mortgage industry, mainly with conventional lending. And there was a team of around three guys at that time. They just wrote conventional loans. Since then, really in 2015, 16, the CEO decided to break into the hard money space, which is now where all of our businesses and where we're flourishing and doing all sorts of crazy flexible lending for investors and helping brokers out there. So we do everything now from your standard fix and flips to ground up construction to mid construction to long-term DSCR loans. So really, as an investor, whichever realm that you're in terms of your project, whether you're starting out or whether you're a seasoned investor, it's most likely we'll have a loan product that we can fit towards your specific scenario there.
Right on. How'd
Going
you
into
get
kind of how, Gone.
how'd you get your start in commercial lending,
So I
man?
got my start. Yeah, absolutely. So as you can tell, I'm not from the US. So I'm from England originally. Came out here around 8 years ago to play college soccer. And I managed to just find myself, wake up one day and I was in Austin, Texas. So not a bad place to land on my feet. So actually straight out of college, I was looking for a job and one of the guys had an internship here at Park Place and said, look, you'd be a great fit. Came on. And then since then, I've been in the industry for 2.5 years, and I've been able to go from a junior AE and just making, the phone calls, what you need to do, to now I run a team of 15, 20 guys who I help get, win their own business. I also have my own book of business as well. And then on the executive level, I'm involved with everything from marketing to how the loan process goes on the back end. So I've really been able to build my knowledge of the industry as a whole instead of just being on the sales side. So really dove into the industry, and it's something that I see as a very long-term career for myself.
Yeah, you sound like a high performer, kind of like myself. I go like 100%. Like I'll just call
Yeah,
300 people in a week if I possibly can. So what was it that kind of took you from being an intern to having this team in such a short
yeah,
amount of time?
yeah. I always say consistency, right? Consistency is the biggest thing that drove me to where I am. There's the right things that you need to do on a daily basis, and it's difficult, and the top performers do those correct things on a daily basis, no matter whether it's sunny outside, raining outside, whether the first caller hung up on you and said, I don't want anything to do with you, right? Doing the right things on a consistent basis and building on that allow me to get to that point and really just diving in to the industry as a whole and trying to learn not only the angle of selling but also learning from the investor's point of view, like hey, what's a good deal? What's a bad deal? What do underwriting look at? What makes a deal a good deal? And learning outside of the office as well through self-help books, investing, content books and podcasts and all the information's out there. It's just being able to go and find that and then implementing it into your day to day.
I'm totally with you on doing the right things every day. In our program, I created what's called our sales macros sheet. So
Mm-hmm.
it's just kind of like, have you guys ever heard of what is it? It's like in bodybuilding, there's your macros. You have to
Yeah.
get your protein, you have to get your carbs, a certain amount of each thing. And we created our sales macros, which is you have to have this many calls every single week, this many term sheets every week, this many relate referral relationships every week. And if you're hitting those macros consistently, just doing those things every single day, you don't have to. I tell people a lot in this industry, you have to have a lot of faith because
Right.
anything can happen at any time and there's a lot of rejection. But if you're
Right.
doing the right things, then your faith grows because you know you're doing the right things. As long as I'm doing the right things, I don't have to worry. The business will come, So I'm totally with you, brother. You have to do your sales macros, 100%.
Yeah.
All right, well, let's get into Park Place, brother. Oh, do you have something to elaborate on that?
No, no, go ahead. Let's get into
Yeah.
Park Place. Let's
Yeah,
get
let's
into
get
the
let's
gym.
get into let's get into Park Place. Do you have anything to share with us? Do you want me to pull up your website, kind of a presentation or anything before I get into the Excel sheet?
You can go ahead and pull up the website just to, show people where to go to get some more information after they watch this as well.
Sure. All right. So I'm going to share my screen, everybody. Let me know if you can see it.
Yeah, we can see it now. Yeah.
Okay, great. So this is Park Place, guys. So if you're seeing a different logo, you're on the wrong website. So this is the website, parkplacefinance.com. We have our Excel sheet here, and I want to run through this Excel sheet. This is one of the best ways to get to know the lender is just through our lender buckets Excel. And you guys are going to see we have a lot of tabs here. These are what we call our lender buckets. Okay, so when you're running a commercial mortgage brokerage, and you get someone on the phone, you need to know what bucket you're going to be placing that person in. And that's going to drive what kind of questions you're going to be asking and what kind of expectations you're going to set with the borrower. So we have Park Place in our fix and flip requests, as well as our 1 to 4 perm and 5+ requests. And we have about, I don't know, 5 to 10 lenders in each one of these buckets. And this is going to help drive your commercial loan brokerage to be extremely efficient, and it's going to allow the right kind of training and loan placements with your brokers that you're hiring, maybe your loan officers or your account executives. So, Joe, let's run through this Excel sheet. You're the one who filled this out, so you can kind of elaborate on some of these points. First off, guys, we have Joe's contact information. So, Joe is obviously a top performer. Our account executives in our Excel buckets are vested account executives. These are seasoned account executives that we know work really well. They know their product really well. One of the big problems with signing up with a new lender, maybe you just fill out the form, hey, I want to be a broker. What they tend to do is they tend to funnel you to the newer AEs who just started with the company. Now, I'm not banging on new AEs completely because they want to work really hard for your business. But the thing is, you end up learning the lender's guidelines with that account executive, and that's a problem. We want professional account executives that know the guidelines better than you. And so that's why we have Joe. You have his contact information right here. That's the first thing you're going to see. So, Joe, when someone finds a deal that, and they're going through this Excel sheet. Okay, it's a $500,000 loan. They do want a bridge. What's the best way to reach out to you, and what do you like to see on your initial submission?
Yeah, absolutely. So first off, John, I do want to say you're absolutely correct. With a lot of lending companies, when you fill out maybe a deal submission form online, it does tend to go to the mass audience of the AEs in there. I can tell you that for coming into any specific lender group, it's really key who you're choosing as your account executive or who you're being placed with, because the more knowledge that account executive has, the from data, the much higher percentage of chance that deal is going to get closed based on the seasoning of that account executive. And it can be really here at Park Place, we try to make every broker's or borrower's experience very similar, and we've got things in place to be able to do so. However, there is always a slight change in who you get as your ratee
Yeah.
there. So I
Well,
do.
as you guys know, in loan originations in the loan business, there's a high turnover with sales executives. Okay, because sales executives might not do so well with the company. They're just starting out, and you don't want to receive that kind of turnover from your AE. You want to stick with one AE who's planted with a lender, knows the guidelines like the back of their hand. So we're just really glad to have a system in place where we're vesting AEs for you and you don't have to learn with a new AE. So what kind of submission, what kind of information do you want to see normally on a submission, maybe in like the body of the email?
Yeah, absolutely. So the main things are really high level details, right? There's really three buckets to what a good deal is or what we look at to vet a deal. So number one, we're going to look at experience of the borrower. And that experience, we really want to get specific on that experience. And that's based on what the borrower has done on title. So a lot of the times you'll get sent submissions and it'll be, hey, the borrower is really experienced, but he's only done work for his brother and painted the outside of his brother's house, right? We're really trying to narrow down on the experience, and these are the questions that you should be asking and vetting with your borrowers up front. And it's all based on what experience has been done on title for them as an investor, um, with their own funds into a specific deal, right? So, number one, I'd really want to see what the experience is. Number two, I'd like to know what the liquidity of the borrower is. That's a huge factor to whether we can do the deal or not do the deal. And then number three would be the deal itself, right? So we're going to be looking at property address. If it's a purchase, I want to know high level details, purchase price. Since we're talking about fix and flip here, I want to know what the rehab budget is and what the after repair value is. With those three main tranches, so the deal specific information, the borrower experience, and the borrower liquidity, um, within 10, 15 minutes of me looking at that deal, checking comps on my end, I can come to a conclusion that yes, this is definitely a deal we can do and we'll take on, or no, this is probably not a deal that's a good fit for us there. So when you're sending those over, those are the main things. Now, I do also have a deal submission form that kind of outlines a bit more in depth than just those three categories, but um, that would give me all the information there as well. And I can share this with John at
Sure.
the end of the call
Yeah,
there.
you can send it on through. In our program, when you join up with us, guys, you get a deal summary sheet. It's basically just a Word doc of questions you want to be asking borrowers generally on any deal. All you got to do is when you're on the phone, ask those questions line by line. It's going to make you sound really smart, and then copy that Q&A and paste it in the body of the email. That's how I like to see submissions in the body of the email. I don't want to have to open up a PDF, fumble around with maybe a password, maybe it's not downloading, maybe it didn't come through in an email. If you just put it in the body of the email, that way you know it actually made it to your lender and they can quickly analyze the deal. So that's fantastic. Now,
Yeah.
Joe, we got to hone in on this real quick. So I have this little section here. It's called Why to Send Them a Deal. This is a bit too wordy for me. I want it quick and simple terms. What makes you stand apart from the other lenders? And I can already say, I'm just going to delete this right now. And I'm going to
Yeah.
say quick closings because
Yeah.
that's the first thing I noticed from you. So tell me a little bit about that quick closing.
Yeah, absolutely. I mean, in real estate, time is of the essence in every facet of the business, whether you're trying to put something under contract, whether you're trying to close in time, whether you're trying to get the rehab done in a certain time. The speed of closing is what we pride ourselves on. So closings typically take around 5 to 7 days of us receiving that initial deal submission. Now, saying that, you know, people can send a deal submission, we'll send them the terms, but then we get no documents for another 3 days. We really say from the day we get the borrower documents to start the file to actually closing that file is around 5 to 7 days there. Now
Yeah,
that
assuming
includes it. Go on, Nate.
right, assuming we have a full file.
Yeah,
Absolutely. I'm with you.
yeah, correct.
So normally with this kind of speed, you need to waive certain things as a lender, waive certain reviews. So are you doing a full appraisal or is this a BPO or tell me about that.
Yeah, absolutely. So right now we are doing a full appraisal. Now it's not through an AMC, which is typically what lenders do want to see, which is an appraisal management company for those that are new to this. Uh, the appraisal management companies can take much longer than going direct to an appraiser. Now, since we've been around in the business for since 2006, we have a full vetted list of appraisers in pretty much every state where we're lending. And we go direct to those appraisers to get the quickest turn time, the best price for an appraisal, to make sure that we can get that back in time to be able to close before the
Yep.
contract date there.
And I believe
Now,
on the deal that I sent you, sorry for interrupting, the deal I sent you, I think we already had an appraisal and you
correct.
allowed for an appraisal transfer. Is that common for all loans or is that just we just kind of got lucky there?
Yeah, absolutely. I mean, we can take appraisal transfers. I think in this case, we needed to close. You guys already had an appraisal. I think you tried to there was a different lender involved previously.
Yep.
So yeah, we can definitely take appraisal transfers. And then what we've actually done, we've actually hired an in-house appraiser right now, who's going through the training and getting integrated into our system. So within the next 2 weeks, we are going to roll out any deal size under 750,000. We're going to do an internal appraised value, and that will be the value of the deal. So our one will be able to give either the broker or the borrower, hey, these are the values that we're going to go off. These are the approved terms based on what you have sent so far. Here's what we need to close out the file. So we can take that close time from 5 to 7 days, hopefully to 2 to 3 days there.
Will you have to do an inspection in that case or is that desktop?
No, no. So that's all going to be internal desktop appraisal reviews.
When are you rolling that out?
So that's going to be in the next 2 weeks here. So the appraiser started last week. He's just going through onboarding training for our company. And then that's going to be rolled out in the next 2 weeks.
That's greater than 750K loan amounts?
That's lower than 750K loan amounts.
Oh,
So
very
anything
nice.
over 750K will still require the appraisal. But anything below that, it's going to be all in-house valuations.
And if you're new to this business, your typical fix and flip is probably going to land in the range of like 100,000 to maybe 500,000.
Yeah.
Your average loan amount is around 300,000 across the U.S. If you're rolling deals in New York and California, obviously those numbers are going to be a lot higher. But the average fix and flip, just say around 300 grand nationwide if you're advertising.
Yeah, absolutely.
So that's actually a really good point for you.
Yeah.
Okay. Why else should we send you the deal, making you unique outside of the, other nationwide rehab lenders?
Yeah, absolutely. I
Other
mean,
CSC.
yeah, for us and me specifically, for me and my team, it's not just myself that's looking at any given deal. I have my own dedicated processor, my own dedicated LOA, and my own dedicated underwriter. So not only do you get my eyes on the deal, you get four other eyes on the deal at any given point to make sure we are closing on time, and looking at everything that comes in with the documents at any given moment. And then the main thing that I do want to harp on is that we are first time investor friendly, whether that's fix and flip, whether that's ground up construction, or whether that's DSCR. And the biggest outlier of those three is the first time ground up construction. We do allow for someone that has never done a flip, never done a ground up construction to actually qualify without having the GC sign on the loan, which is
Fantastic.
something that I've been to a lot of conferences in the past 2 years, spoke to hundreds of lenders, and it's just not out there right now.
Yeah. Yeah. Typically, for someone who just wants to start out doing fix and flips or buying rental properties, they need to partner with somebody who has that experience, get them on the loan docs, which is kind of a tough pitch, right? So, and he's totally right. Most lenders, if you're going to be doing a fix and flip, they want to see that you've done at least one or maybe three in the last few years. So this is a huge sales point, and yeah, definitely a good thing to market to our borrowers. That we have a lender fit for that. So that's fantastic. Okay, those are good. So let's go through this list and we'll just make sure everything's correct and you can elaborate on any of these points. So no rural locations, right? So this is very common. Most lenders don't mess with rural locations. Can you elaborate on what you call rural?
Yeah, absolutely. So rural, we're looking at MSAs of lower than 50,000. Now the MSA isn't just the town it's in, it's it's the greater outside of that town within the MSA. So the best thing that you can do to get a quick check of whether we're going to consider it rural or not is just go on Google Maps, put in the address, scroll out. If it's in the grey, most likely we will lend there. If it's in the green, most likely it will be deemed as rural. And that's a real quick tool that I use when I'm on a call to vet it. Obviously, we go into more depth, right? But if you're on the fence of sending it over or not, still send it over. It'll give me 2 minutes to get back with you and give you the verdict on whether it's rural or not.
Yep. Um, I'm with you on this point. My easiest way of vetting a property rurality is gray green. So just to kind of give you guys some clarity what that means, gray means if I look up an address and I see a lot of concrete, a lot of streets, a lot of brick and mortar, gray, right? City grayscape, right? Then, obviously we're going to have a lot of sales comparatives, and that's going to make the lender feel a lot better about their liquidity position in that area, meaning there's a lot of properties moving versus green. If I look up a property and all I see is green surrounding it, that means we do not have a lot of sales comparables out there, which means we can't have confidence on values. So this is the
Right.
quickest way to check for private lender virality because USDA has their rural designations, but private lenders work a little bit differently. Gray versus green, I think, is a great way to explain that.
Yeah.
Okay, let's dive into your loan amounts. So you're telling us your loan amount, your niche is small balance, 100,000 to 3 million. Um,
Correct.
is there exception to the loan amount in any cases on
Mhm.
something like this?
Yeah, absolutely. So since we're a 1 to 4 family lender, a lot of the deals that are coming across our desk typically fall into that 100K to 3 million range. Now, there's always room for exception. The private lender industry is very fluid, and we're always working in the gray area every day, right? If the deal makes sense in terms of the three buckets that we spoke about at the start of the call, experience, liquidity, and the deal itself, there's always room to make an exception to go higher than the 3 million. So we've definitely done it before and we'll definitely do it again. The deal just really needs to make sense at that point to be granted that exception. And the way we look at that is through compensating factors, right? There's multiple compensating factors through every given deal. It can be credit, it can be liquidity, it can be the borrower has experience doing similar projects of this size. It could be a liquid market. We really like the market. There's a lot of different things lenders look at other than just the profit of the deal. We go into a lot of depth. And one thing I would say, especially about working with us as a lender, is if we want to go ahead and do a deal and we start moving a deal forward and get you terms out, there's really a 95% chance that that will close because we actually want to do the deal, right? We're not just doing a deal because you sent it and we want to try and make it work. We have a leverage position in every deal that we're doing as well. So we're not going to do a bad deal that will end up hurting yourself or your client, right? We want to keep everyone at a good risk position based on every single deal. So definitely always keep that in mind as well when you're working with us.
Right. Those are great points. Remember, guys, private money lenders, they have investors that they need to deliver a return for normally. Okay. So investors are coming in, they need to give a return for those investors. So they want to originate your loan. They want to get more fundings out so they can give that return to their investor base. So that's a really good point. And then also compensating factors, you guys, huge. One of the biggest compensating factors, it all surrounds the sponsor mostly. It's not necessarily going to be location normally. It's going to be sponsor driven. So if you have a high value asset with a lot of rehab money needed, well, I really hope that borrower can show a lot of liquidity if we're having to get an exception on the loan amount if it's too big, right? experience, obviously, and yeah, no, those are great points. So let's get on to your term. You're pitching a 12 to 18 month interest only loan. That's pretty typical for fix and flips.
Mhm.
Um, the 12 to 18 months, do you guys offer extensions after the maturity for percentage points? Tell
Mhm.
me a little bit about the term, if there's anything in there that we need to know on selling your product.
Yeah, absolutely. So yeah, 12 to 18-month term. That's over the fix and flip and the ground up construction and straight bridge loans as well. Interest only, no prepayment penalty. That's one key thing to new borrowers that you do need to explain. No prepayment penalty basically means that they may finish the project in 3 months, and they either then perform their exit strategy with a sell or with a refinance. They need to know that there's no back end fee for paying off the loan before that 12 to 18-month term. Um, that's a really good selling point to new investors that they should really be aware of. No back end fee there. In terms of extensions, we definitely do allow for extensions. We don't want to be, pushing people to maturity and default come, the end of the term. We're definitely flexible and work with the clients to give them an extension if needed. So those extensions look is we allow for 2 3 months extensions past the maturity date, and it really comes down to the cost of capital at the time to what that fee looks like. So it can be anywhere from 1 to 3% of the loan balance. Most of the time, people are falling in that 1% category.
Yep, fantastic. Okay, you have 1 to 3 points depending on the deal factor. I'm
Mhm.
assuming the deal factor is how big is the loan amount, right? On
Yes.
whether we're charging 1 or 3 points. So
Yes.
a 3 pointer, I'm assuming would be like $100,000 loan amount
Correct.
versus
Yeah.
yeah, go ahead.
Yeah. So we have a minimum origination of 3,000. That is basically to cover our costs. There is costs associated with doing the loan, i.e., underwriting, processing. Time is probably the biggest thing um, that we need to get paid for. Right at the end of the day, AEs spend a lot of time on any given deal. So 3,000 is the minimum origination, and then I'll make the deal work. Right, that's the biggest thing on origination. I'm never going to lose out on a deal and have that deal go to another lending company solely based on origination. That's something that's up to the discretion of any AE for the most part. It changes company to company, right? Um, but we'll definitely make it work for every party involved, i.e., borrower, lender, and your commercial brokerage firm there
That's
as well.
right. We're not charging no YSP normally on short-term loans, guys. Very common. So that's this point right here. They're not white labeling. A lot of lenders will allow you to white label the term sheet, but they want to show on the HUD. Some lenders will allow you to white label on the term sheet and show as a lender on the HUD. Uh, Park Place is more of a traditional fix and flip lender. They're going to show as the lender throughout the whole loan. Investment 1 to 4s, that's what you're doing here. So that's typical. But I do see that you're doing some 5 plus. So
Yeah.
how high up do you go on a rehab loan for 5 plus?
Yeah, absolutely. So for 5 plus, we can go higher in loan amount. We can go up to 5 million, and we can go up to 52 units. Now, per door, we're looking at 50,000 minimum as is value on those multi-families. And to be fully transparent on the multi-families, that is a secondary product to our 1 to 4. It's something that we do offer our really experienced clients. If they do happen to, work the way up as an investor and start doing multi-family deals, we want to still be able to offer that service to them. However, our 1 to 4 family is the main um, realms of lending that we do play in.
Right, right, right. Well, there actually aren't very many lenders that offer a multifamily rehab loan outside of commercial bridge lenders.
Mhm.
This is more of a traditional fix and flip loan, right? Lender scenario. So that's
Correct.
actually quite interesting. Most lenders cap out at like 5, maybe 6, maybe 9 units. But 52, that's actually a pretty good sales point. And I'm sure you guys, they're going to be more conservative on these loans. That's what he's telling you by saying, hey, we're primarily a 1 to 4 rehab lender, right? So if you come to him with a multifamily asset, don't expect to get the same LTVs that you would on a 1 to 4. They're going to want more liquidity, more investment from the borrower, skin of the game on the multifamily asset because there's just more going on. More units, more contractors. You get the gist. So obviously you're doing purchases. We already know that. But let's get into refinance. Everybody refinances on rehab deals a little bit differently. So let's say this is a very tough situation for most lenders. Let's say a borrower started rehabbing a property, and they ran out of cash or whatever, and now they need to refinance this loan. Maybe it's owned outright, and
Mhm.
now they need more money to finish the rehab. How do you treat refinance rehab situations,
Yeah,
distressed assets?
yeah, absolutely. It's a difficult one for a lot of lenders. A lot of lenders do not want to take on midstream construction rehabs. Reason being is something had gone wrong either with the previous loan, the contractor, the workflow. So there's already red flags when that deal comes in. However, we do take those on board, and we love to finance mid-construction refinances, right? It's a niche product that we do offer, and we work very well in that space. So how we're going to look at that. A lot of it comes down to value, right? It's difficult to, as a lender, to pinpoint a value of the asset when it's in a distressed mid-construction state, and that's why we do get appraisals on those and look at gross adjustments and so on. So what we're going to look at is time frame. So if the borrower has purchased the property within a 2-year time frame, we're going to go off the lower of the cost basis or the as is value. When we say cost basis, we're saying what did the borrower originally purchase the property for, plus what has the borrower injected in terms of capital into the rehab. So we'll go off the lower of those two if the borrower had purchased the property within a 2-year time frame.
Will you refinance them out of debt if they failed with another lender?
Depending on the reason of failure, if it's lack of payments, then unfortunately we're not going to take on that deal. If it's due to maturity but payments have still been made, we're definitely going to take that deal on. And then whether it's just they've ran out of capital and didn't structure the initial deal correctly, or stuff happens within real estate, right? But budgets can change throughout the project. We'll definitely finance those deals as well.
Right on.
Um,
Okay. Mhm.
And what we'll finance on those refis is we can go up to 75% of the lower of the cost basis or the as is value. And then we'll also finance 100% of the remaining construction needed to complete that project, up to 70% of that after repair value there.
That's fantastic. And these are typical, you guys. That's a typical guideline right there, up to 75% of after repair value, total loan amount. So very typical. Now let's get
Yeah.
into quick bridge with no rehab. So that's the loan that I sent you. It was like, hey, guy just needs a bridge. And you're gonna see scenarios kind of like this. Borrower rehabbed a property, they're planning on selling the asset, but guess what? Rehab took a little bit longer. Now their note has matured with the current hard money lender. It's been 12 months. They haven't been able to sell the property. And now what are they going to do? They don't have a lease in place. They can't really get a debt service loan, and they want to just pull some cash out of this rehabbed asset. This is typically what you're going to see for a bridge with no rehab. Um, Tell me about this. Or you guys are cool with that, right? I mean, we funded one the other day.
Yeah, absolutely. Yeah, we're definitely cool with that. There's really two transaction types that the bridge work for is bridge purchase and then also bridge refinance, right? So as John was just saying, for the bridge refinance, you're going to come across a lot of constructed properties that may be on the market. Investors need cash flow a lot of the time. They need to maybe pull that cash back out of that property that they've just done to then go put an offer on a new property and start that project, right? So we'll help them free up that capital to do so, whilst that property sits on the market to sell, and it obviously gives them a longer time to then sell that property along a long term, and maybe a lower rate as well. They may have been
Right.
at a higher interest rate, and on those bridges, there may be things where I could knock the rate down 1% to what they were originally paying there. So,
So there has to
um,
be a net tangible benefit. Is that right or no?
in what way, John?
cash net tangible benefit, maybe bringing, does it matter if their rates going down or going up coming with you?
Not particularly. I mean,
Good.
that's not really what we're looking at. The main thing we're looking at is the exit of the bridge loan, right? That's the biggest thing as a lender we're going to look at when a bridge loan and no value add is happening to the property is why go into a short-term loan when you could go into a long-term loan here?
Right.
A lot of the time it's speed of closing, which we just spoke about on a purchase. We really need to get this property. We have 4 days to close on it, and then we're going to refinance into a longer-term loan. And then on the backside for a refinance, hey, my loan's coming to maturity. My exit strategy is to go on ahead and sell this property. We'll look at the market. Yes, it's liquid. They just need additional time to sell, and then we'll do that deal on the refinance
Fantastic.
side.
Ground up construction, you do require experience. What is that experience guideline there that you're seeing for ground up?
Yeah, so ground up we actually don't require experience.
Okay.
Yeah,
That,
so
that's
the,
actually a
the
big deal.
yeah, that's a huge deal. So a lot of lenders say they don't require experience. We truly do not require experience because we do not require that the GC signs on the loan documents as a personal guarantee.
Wow. That's a big
Yeah.
deal, guys. Most ground up lenders are like, if you haven't done a build, I don't want to have anything to do with you. Building, there's a lot of factors. I actually don't pursue ground up construction loans from my brokerage. They're just too complicated. There's a lot of permits, takes a lot of time, a lot of factors that could kill that deal. So I just stay away from them. But if you are networked in that community of builders, then this might be a huge plus for you, especially with if you're in a, I mean, right now, ground up construction is one of the biggest pitches. If you go online, look at social media, people are like, don't buy and rehab a property right now. That's the worst thing you can do. They're saying buy land, rebuild, build right now, right? Because the
Yeah.
margins are too tight right now on the rehabs with the kind of the speculation in the market. Everything's kind of slowing down where things were shooting up. Now we're kind of like leveling off, unfortunately. So ground up construction is a big deal. You have a lot of first time investors wanting to do this, being that social media is pushing it so hard right now. So this is a great product.
Yeah, absolutely. And I want to harp on the ground up construction product as being one of the most niche, best products that we do offer. Not only are we lending to US citizens, we're also lending to foreign nationals on that ground up construction product as well. The foreign national either has to have a US visa or an EAD card, which is a work authorization card, which just allows them to be in the country and invest here. So we definitely do lend to them. I can tell you right now, 50% of my book of business is strictly ground up construction. I'm an expert in how to structure any given ground up construction deal. And the beauty of it is a lot of infill that investors are doing for ground up construction. Day one, we really know what the values are because we can look at the plans of the build and we can look down the street and that similar plan has been already constructed and built and sold. So the values, there's less discrepancy within the values of that any given deal.
Okay,
So
how do you approach someone with raw land?
yep. So we're going to get an appraisal on the land. So we'll go again. We'll go off cost or as is value within that 2 year time frame, which we just spoke about. That's the same for land. And then we can use, let's say they've already purchased the land, we can use the equity that they already have in the deal as their down payment
Yep.
for when we come to do the refinance on the land.
And from my
On,
experience, most ground up lenders go about 50% LTV on the land value if they already purchased it. Is that same in line with what you have going on?
yeah, absolutely. So max we can go up to on the land is actually 60% LTV, and that's on a purchase or a refi. There's really two buckets that a borrower is going to fall into. It's 0 to 2 ground up constructions on title. You're going to be at 80% loan to cost, that total cost being land purchase price plus construction. And then at 3+ on title, you'll be at 85% loan to cost.
Got it.
Again, land plus construction.
Wonderful. Recourse, you guys, if someone argues with you about recourse on a regular fix and flip, just tell them to eat rocks. Entity,
Yeah.
entity required. Most lenders require an entity. It's private money lending. They'd rather ensure that this is a business purpose loan, and they do that by lending to entities exclusively. So guys got to have an LLC. If they don't have an LLC, again, tell them to go get an LLC if they want to do rehabs. Appraisals required. We already covered that. Fantastic. And guys, I'm going fast right now because we're running short on time. So I'm going to try to work through these quickly. Um, Appraisal reassignments accepted. Yes. Speed to close. 5 to 7 business days, guys. Don't, when you're on the phone with your borrower, don't tell them, I'm going to close you in 5 to 7 business days. You're going to tell them, let's get your information first. If everything looks good and I have a full package, once we have the full package submitted to the lender, after you've accepted terms, paid for appraisal, then we can talk about 5 to 7 business days. Okay. LTVs, 90% on purchase, 100% on rehab. I'm assuming that's up to 90% for experience, right?
Yeah, absolutely. So that's up to 90%. Way to get there is 5+ experience on title.
Gotcha. 100% on rehab, max ARV, 70%. Didn't we mention 75 earlier?
Yeah, so that's actually changed since we filled this out. That is 75. Yeah.
All right, perfect. Oops. 75. Oh, what's going on? Oh, my number lock. When the number lock isn't on 93, so that's kind of an awkward number. 93 on loan to cost. This is
Yeah,
what it is.
it is what it is.
Okay.
I'm going off what I'm being told.
All right. 90% is normally as high as lenders go. It's either 90% loan to cost or 75% ARV, whichever's less. That's typically what you're going to see from lenders. They have 93, so there's a little bit more room on the loan to cost side. And if you don't know loan to cost, guys, I have a video in the training all about how to calculate loan to cost. It's quite easy. Purchase price plus rehab costs equals your total cost, and then you multiply that number by your lender's guideline, which is 93%. That gives you the max loan amount. Moving on, borrower FICO 660. Do you have exceptions on this FICO score? Is it a hard stop?
So FICO is a hard stop. 660 is the minimum there.
Okay. What if they have two guarantors? Do you go with the lower of the two or the higher of the two?
So we're going to go with the lower of the two. Now, what I always say if the borrower's got low credit is we always ask the question, do you have a co-borrower that is either already on the LLC or that you could bring on the LLC? The percentage ownership to where we're going to look at the credit score and not look at the credit score is anyone over 20% ownership on the LLC. We can use them to qualify for the loan. Anybody under 20% ownership on the LLC, we're not going to look at their credit. So let's say you have one borrower with really good credit and one borrower with bad credit. Well, we'll make it 81-19. And then that way we can still qualify based off the higher credit.
Gotcha. That 20% guideline is pretty typical as well. Some lenders want to see 50%, but that's a good number. Max, they don't have credit utilization requirements, minimum experience. We already went over that. So that is their fix and flip request. You will find them in our fix and flip bucket. We have this one listed as 1 to 4 bridge. GUC stands for ground up construction and fix and flip. So that's where we're going to find them there. From what we've talked about, I think I should put you in our specialty ground up focused area as
Yeah.
well, since you guys, when you hear someone's portfolio is, especially an account executive, is 50% ground up construction, that tells you what they're good at and how they're playing against the marketplace. 50% ground up construction is a fantastic number, and you can assume that they are really good at it if that's what they're originating right now. So I actually really like to hear that.
Yeah.
Moving on. Okay, Joe, I'm not going to dive too far into this, but a lot of lenders who do rehabs are also going to have a DSCR product. There are a lot of warehouse lines you can get from banks to, provide for a DSCR product. So they have a DSCR product here, basically long-term financing, kind of like an exit strategy for these rehab builders who want to go into that BRRRR strategy, right? Rent, rehab, refinance, right? They want to refinance into the perm loan. So what I'm seeing here is they're doing multifamily typical. They're doing 30-year on 1 to 4s as well. Anything special that you can mention about your DSCR product that just might make you a little unique before we kind of call it on this sheet?
Yeah, for sure. I mean, DSCR from lender to lender is going to be very typically similar within 50 bips of each other, right? The main thing that kind of sets us apart is the flow of how we process. Again, time of closing. Typically, a DSCR is going to take anywhere from really up to 30 days, right? We kind of pride ourselves on a close time of around 14 days, so a 2 week time frame of getting the borrower docs in to actually closing that deal. Um, so that's really the biggest niche of the
Yeah.
DSCR loans. And then obviously pricing, it's always competitive within the market space. I always go on every day and take a look. All right, where we looking at pricing compared to our main competitors, and for the most part, we're actually really competitive in that space as well.
Yeah. I don't get into the pricing, normally on these calls because pricing changes.
Yeah,
Most DSCR lenders are going to be around the same pricing. The lenders that have a no ratio requirement are going to be higher, but it all depends on the borrower's needs. So you guys are running a regular DSCR program, which I'm assuming has ratio requirements. So what are
yeah,
those requirements on 1 to 4 versus multifamily?
yeah. So we can go down to 0.75 for a 1 to 4. And then for the multifamily, we're looking at least a 1 DSCR ratio for a purchase and then a 1.25 for a refi.
Good. 0.75 is actually fantastic.
Yeah.
Other DSCR lenders, you're looking at about zero point 0.8 normally, and on multifamily, normally 1.2. So this is good. 1 to 1 on a purchase is actually pretty good.
Mhm.
Normally, they do a standard 1.2 on multifamily, whether it's purchase or refi. So that's pretty good.
Yeah.
Fantastic. All right, Joe. You did it. Thank you so much for lining this out for us and elaborating. You guys, my sheets can only take you so far. The sheet is meant to allow you to pre-screen a deal quickly with someone on the phone and quickly place that loan with the right lender. When you get a deal, you see that it matches, lines up with what Joe does. Your next step is to hit up Joe with all the details that you learned on the phone and ask him, okay, where am I going to land on pricing on this? So you can give a quote to the borrower maybe same day. But
Yeah.
truly, you need to contact the rep because there are going to be exceptions in here. You need to contact the rep, get into the nitty gritty. This is simply used as a pre-screener placement tool for your loans. Joseph, or you probably go by Joe. Joe, you were fantastic, man. I appreciate all your time today. Again, best way to contact you to get lined up as an account, excuse me, as a loan officer or broker with you guys. Um, Tell us.
Yeah. So via email is number one best thing. I use my email as my checklist every day. It's a to-do list. Everybody that comes into my email is absolutely going to get a response. So send those emails over with either questions, deal submissions. Always happy to jump on a call initially just to introduce myself, go over the way the full process works with you. And then also, John, like I said earlier, I'll send you my deal submission link. That's also a great way of getting to me. But number one is always going to be email to introduce yourself, to send the deal over, to get pricing, answer a question. Email is what I'll live by. And I've got it on me, 24 hours a day for the most part.
Absolutely. And Joseph's extremely, I keep calling you Joseph. Joe,
Yeah.
you're extremely responsive. Fantastic work so far. I love to close loans quickly. That's what this business is all about. So you guys, I want to thank you so much for watching this Q&A session. If you are in our community, you will receive a recording of this Q&A session as well as this Excel sheet. And if you're not, consider joining and you can actually be live on these calls as well. So thank you so much, Joe. Thank you everybody for watching, and we'll see you guys on the next Q&A.